Hello and welcome to FMI's Built-In Podcast. I'm your host, Scott Winstead, President of FMI Consulting. We're kicking off 2026 with a topic that continues to be top of mind for owners, for boards, and for leadership teams across the built environment. That would be mergers and acquisitions. I'm joined today by my colleague Alex Miller to share FMI's perspective on M&A in 2026 and help frame how leaders should be thinking about growth, optionality, and capital deployment in the year ahead. Alex and I begin with a look back at what we saw in 2025, both across the broader M&A landscape and within the engineering and construction sector specifically. From there, we turn our attention forward to what we believe will shape deal activity in 2026, including shifting construction demand, evolving delivery models, the role of private capital, and how both strategic and financial buyers are approaching valuation and risk. Alex is a managing director with FMI Capital Advisors and a co-lead of our Contractors and Construction Services group. He spends his days working alongside owners and leadership teams on some of their most consequential decisions. This episode is intended to help leaders think more clearly about where M&A is headed, where it fits, or where it may not fit in their broader strategy as we head into 2026. Well, Alex, welcome back to the show. Thanks so much for being here.
Hey, Scott. Thanks for having me back on.
Well, I'd love to start off just with a bit of a look back into 2025 to look forward into what we think we'll see from an M&A standpoint in 2026. So having said that, what did we see last year from an M&A perspective, both big picture and go into some detail around the E&C space in particular?
Sure. And Scott, I don't remember how many years. I think this might be the third year that you and I have done this in January. And I think every year I start it the same way, which is, I say, hey, the year before we were entering with a lot of optimism and then it didn't live to fruition. But 2025, it was similar, but it got a little bit closer to kind of living up to expectation. So the way I kind of define it is, look, we entered 2025 and like we entered 2024, kind of like we entered 2023, right? High expectations, a lot of activity that was pent up, a lot of demand that we thought was out there, expectations for a really, really strong market. And Q1 got off to a very, very strong start. But then, as we've always kind of said, we don't always need a good market to be conducive for M&A. What we really need is a stable market. The hardest thing to getting deals done is a volatile market. Buyers and sellers just have an inability to make a decision in a changing market because, they want to make sure that they're making decisions on kind of sound, strong, stable foundation. So Liberation Day hit and it kind of put a pause in activity in 2025. Q2 was a lot slower than Q1 as people really started digesting the implications of tariffs and other policy changes and just looking for clarity in terms of what is this market going to look like and how do we make sound decisions. The positive part is that once we kind of started getting a little bit more progress on trade deals, once we got clarity over the big, beautiful act, it created a lot more of a conducive environment for M&A. And so overall, 2025 wound up being a growth year in terms of total M&A volume, really, really fueled by a strong second half in the year. So that's kind of the macro view. If you look at it specifically within engineering and construction, 2025 was another excellent, really strong year. So part of the activity in 2025 was going to be fueled by those macro trends. When the whole market is strong, we're going to be strong alongside it. But even over the last couple of years, when the market was softer than expected, engineering construction continues to be a bright spot for M&A activity across all sectors. And I think what we're going to look back years from now, and we're going to look at what has happened in the last kind of 3 to 4 years is really a step change in the industry. The level of activity that takes place, the way that strategic buyers are thinking about acquisitions as a driver for their strategy, the way that private equity firms have entered into our marketplace really changed. And it's been a step change in the industry. And I think that 10 years from now, we're going to look back and really see that this was a consolidation event that took place that really changed the dynamic and the landscape of engineering construction delivery. So 2025 deal count wound up being probably 10% higher than 2024. It was 35% higher than 2023. I mean, so we're seeing year over year growth, and all of this is at an elevated level from what we would have seen 5 to 10 years ago. I mean, the market has really learned how to do this, how to do M&A. And so we're just seeing sustained activity in our marketplace, and we think 2026 is going to be the same.
So just to build on that, Alex, curious what key trends do you anticipate will shape the M&A landscape for this year in particular?
Well, maybe before we talk about specific trends, I want to start with this. Holistically, we believe 2026 is going to be a very strong year again for M&A activity in the E&C industry. And, I think as we spend more time talking together, Scott, we're going to talk about specific trends, drivers of activities. Really, we're going to pick some specific areas that we're seeing that we see something interesting taking place. But I want to start with saying buyer and investor appetite for all types of assets within our industry, the appetite for those assets has increased. And that's from civil to industrial to building. It's from design firms to construction managers to specialty trades. And so, the market is strong for all participants and all types. And we expect to see another year of really strong M&A volume across all sectors within our industry this year. So, maybe we'll go back to 2025 real quick, right? Who are the big winners in 2025? I think you would start with consolidation within, on the construction side, consolidation and the MEP space continues. It remains a fragmented market. We're continuing to see consolidation of the MEP trades. 2025 was the year where the electricals really had their moment. We've seen a lot of activity in mechanical, really fueled by HVAC, then led into kind of more, complex mechanical systems. 2025 was the year where electricals really had their day in the sun, and we're going to continue to see that in 2026. Other areas within, specifically construction that we saw a lot of activity in 2025, roofing and exterior building services created a lot of demand. We can talk about that as we kind of, go through some of the other trends that we're seeing. Environmental, geotechnical, remediation-oriented firms, those that are really dealing with the ground in which we build, have had kind of increased activity. And then anything really touching infrastructure and utility trades, right? The services in and around that. So on the construction side, those are some of the areas in 25 that we saw a lot of activity. On the engineering side, it's really everywhere. Obviously, we're going to talk about a couple of the real power alleys, which are power and infrastructure and environmental. But, the engineering space just continues to see a lot of consolidation, a lot of activity. And we can talk through that. We talk through 2026. But so talking about what are the trends that we expect to see in 2026, I think you can really organize those into four big themes. And the way that I like to think about that is there's shifting demand in the marketplace. There is shifting delivery of how the work gets done in the marketplace. There is an evolution of private capital markets that is taking place. And there's an evolution of how strategics are participating in the market. And when we go through those, and we can kind of spend some time maybe going through those one by one, what you'll see is that simply at a 10,000 foot view, you can summarize demand for M&A pretty simply as we are operating in a market where labor and talent scarcity exists. There is a need for specialized capabilities to meet some of that shifting demand. And when you put that into kind of a cauldron and you add into that public and private strategic buyers that are sitting on a significant amount of cash, increased demand from private equity firms who have learned how to participate in our marketplace, public companies who are trading at recent record highs, and a financing market that's finally becoming a lot more conducive to M&A, you're going to have the ingredients for a really strong M&A market for engineering construction firms into 2026.
Let's start with shifting demand and how the current forecast for construction spending is impacting the M&A landscape.
Scott, I think like every year, you're going to have Jay on probably next month, and he's going to sound a lot smarter than me. But I'm going to step on his toes just a little bit as we kind of talk about construction put in place. We haven't, I don't think, come out with our full 2026 outlook yet. But when you look back at kind of where we think 25 is going to land, 25 overall in construction put in place is going to have a small contraction from 2024. And so it seems counterintuitive for me to tell you that we're sitting here having having this record amount of M&A activity in the engineering construction space while we're also talking about a contracting construction put in place market. So how can that be true? And the fact is that there are areas where we are seeing accelerated growth, and those are the areas where people are really leaning into M&A activity. So I've made it this long and I haven't said the word data center yet. So I think it's time that we go ahead and have that conversation. But, there are some elephants in the room that are really driving a lot of activities. Data center, mission critical, and then, tangential and very related to that is power, right? Specifically grid modernization and really decentralized capacity that's going to be needed to service load growth that is a byproduct of the elephant in the room that we're all talking about, which is data centers. So, when we think about shifting demand, what we're really talking about is where is that construction put in place spend happening? And so we'll start with data centers. And Obviously, there has been a lot written, and we're going to probably be talking all year long around the level of activity that we're seeing in data centers. But where that comes into play on the M&A side is, like I said before, there is a rush to acquire not just capacity, but capabilities. We're in a labor and a talent scarcity market where we need those capabilities, but we really need them where the spend is taking place. And so there is a premium today for MEP firms that are participating in that marketplace. And obviously the MEPs and the engineering firms that are touching mission critical have been the real winners. I mean, that's where the real premiums are being paid. That's where the big mega deals have been shown. That's where the activity is. But we're starting to see that trickle down to just about everything touching data centers. So think about that in terms of CM and project delivery, testing and inspection services, site and civil services, cooling and thermal management. We're going to shift into on-site or backup power services. You think you go from there, we're going to start talking about the digital infrastructure integration that needs to be happening. We're a generation into this. And so what does that mean? Well, it means that we're due for retrofits coming up. And so the project delivery services that are required to retrofit, all of that is areas where we're seeing just real interest of M&A activity. So obviously that's the data center side, coupled with data centers is power. And when you take load growth and you mix that with the transmission needs and you mix that with an aging infrastructure, and then you couple that with this energy transition theme that is, a generational transition that's taking place, I mean, you're going to see sustained E&C demand, and it is driving activity for anyone that touches power and power delivery as we work to address the demand that's being created, not just from data centers, but certainly that's a big component to where that demand's coming from. So I think those are the two areas that we would talk about, in terms of shifting demand, where you're going to see the big shining lights. But I want to talk about a couple of other areas that maybe don't get as much attention, but where we're still seeing a ton of activity. The first is going to be traditional infrastructure. So when Jay comes on next, I'm sure he's going to talk about where we see, outside of some of those power alleys, non-residential construction put in place, taking a step back. That tends to be the markets where we see traditional infrastructure spend accelerate. And while IIJA is set to expire here, towards the end of this year, I think we're optimistic that federal funding is going to be there for a renewal period. And I think that when you look at the demand and you look at the need within our country, there continues to be a lot of demand in and around the ability to just address aging infrastructure. And so we're seeing buyers that want to step into that market, both on the engineering and the construction side. Kind of right alongside that is water. Water was one of the bright spots in 2025. I think, we're forecasting that to be kind of a high single-digit growth in terms of construction put in place. And water is interesting because it's shifted from not just being about the infrastructure anymore. It has really become a conversation around public safety. It's become a conversation around climate resiliency. It's become a conversation around regulatory scrutiny. I mean, it's a specialized market where, again, we're not just buying capacity, we need to buy capabilities. We need technical, specialized capabilities to meet the demand within water. And so that's an area where we see shifting demand for construction put in place, and that's driving M&A activity. And then the last one I would point out, which is, kind of sits in between that traditional infrastructure and water, is marine infrastructure. It's an area where we are seeing, additional port infrastructure investments. We're seeing demand being needed to be met for coastal resilience, for required maintenance. And so increasingly, we're starting to see M&A activity stepping into marine and dredging. I think about that as an offshoot of that geotechnical and environmental conversation that I had earlier. But those are other areas where the shifting demand, so acceleration of demand, is taking place. What I'd say in the offset to that is that, okay, so we have these markets that are growing fast. What about the markets that aren't growing as fast, right? And when you think about the markets that we're not seeing growing as fast, those are going to be those traditional kind of non-residential or residential building markets. But those are coming off of a generation of accelerated building. Well, what does a generation of accelerating building create? It creates a larger asset base that now needs to be maintained. So when we're talking about those growth segments, we're seeing buyers that want to step in to grab capabilities to meet the demand of the growth segments. We're also seeing buyers that want to grab the capabilities to service and maintain the asset base that was created even in the slower growth or declining new construction markets. So if you're participating in office or in residential, Where the capital is flowing to is those that are not necessarily tied to cyclical trends, but those firms that really have the ability to service and maintain and retrofit those existing asset base. So you kind of think about, Jay always talks about how there's not a monolithic construction market, right? There's, in any market, there's going to be those that are growing and those that are declining in terms of new construction spend. And what we're seeing is those that are growing are seeing firms that are really flooding in and trying to grab capabilities to meet that demand. And those that aren't growing, buyers are still stepping in to grab capabilities. They just want to grab capabilities to meet the maintenance and retrofit demand of those marketplaces.
Following your sequence from earlier, Alex, you mentioned delivery as a driver for activity. What did you mean by that?
Yeah, so go back and let's talk about shifting demand. Where is that demand happening? The demand is happening most aggressively in data centers and power and water and in recent years in manufacturing. Well, the accelerated spend that's taken place in those markets has allowed a couple of things to happen. First of all, these are really large, complex projects. They require participants in that marketplace to bring more to the table than they would have had to bring in other sectors. Some of those markets and some of those projects, the owners really prioritize time to operational over cost, right? Speed and certainty is more important than cost in a lot of these markets. And because of those things, there's demand from a lot of these sectors where the owners are not tied to the way traditional delivery methods, right? And so the way that we have constructed kind of vertical construction over this, over decades, that paradigm is shifting because of the speed to delivery in a lot of these markets and where that demand is taking place. So what that requires is if you are a participant who wants to participate, if you're somebody who wants to participate in these markets, you really want to figure out, okay, how do I get earlier influence on the owner? How do I create faster execution to the owner? How do I give the owner more certainty? And how do I show the owner fewer handoffs? How do I show the owner more integration in our delivery so that I can meet their demands and their needs? So I'll give you a couple of examples of how we're seeing that dynamic play out in the M&A market. One would be that as project sizes get more complex and as owners have much larger and larger and larger capital budgets that they're putting to work on a much more accelerated schedule. So think about what we saw in semiconductors a couple of years ago. Think about what we're seeing in data centers today, right? Those owners, as they're really working to get speed to operation over cost, there's an increased reliance on consultative services to deliver that work. So we're seeing increased use of owner's rep. We're seeing increased use of CMPM or other consulting services. Well, what does that mean? Well, it means that as I am someone who's participating in that marketplace, if I'm a design firm, I may want a CMPM capability alongside. If I'm a general contractor, I may want some design capabilities so that I can augment or that I can be supportive to the owner. So we're seeing more and more of these owners and these public agencies that need delivery capacity and are looking for more that the participants on these projects can offer. And again, we're not trying to grow capacity. We're seeing buyers who want to grow capability. And so I want to be able to do more for an owner because that owner requires speed to execution. And the best way I can kind of get that project to be value add to them is to offer them more in that project. Another example is going to be offsite capabilities. So when we talk about shifting delivery, prefab is no longer experimental in healthcare and data centers and industrial projects, right? This is no longer something that we're trying to figure out. This is table stakes now for those markets. And as schedules accelerate and as labor becomes more and more scarce and as safety becomes a higher and higher priority, owners are showing up and saying, how are you going to solve for my schedule and for the labor capacity that we have here with your offsite capabilities? And so engineering firms and construction managers and trade partners are all working together to figure out, well, how do I leverage prefab or modular capabilities to be able to meet my owner's demand? So we're seeing a couple of different things that come from that, right? One is that we're beginning to see the trades who were the first ones to start thinking about prefab and modular, who are getting more and more and more influence over those projects. But we're also starting to see this shift towards even some general contractors who are saying, hey, we need to ensure that we can provide this solution to an owner. Maybe we need to start thinking about acquiring it or developing it ourselves. And so as we think about the shifting delivery, it's shifting what are the types of assets that we want to be buying and who do we want to be targeting and who has value in a marketplace where speed and certainty are really important. The final thing I might talk about within shifting construction delivery is not necessarily project complexity or the need to kind of be more consultative or create offsite solutions, but it's also kind of where these projects are taking place and the shifting environment that we're living in. And so one area that we're seeing a lot of demand for services is in and around firms that can provide geotechnical and environmental services. And that can be both, the engineering consulting as well as the remediation and the geotechnical contracting that goes into it. I mean, some of that is really due to big macro trends that we've talked about before. You think about climate resiliency and you think about, a lot of other kind of big macro themes that we've talked about. But some of it also is just as these project sizes get bigger, the need to provide a solution that is cost effective and that is conducive to kind of to what the owner wants to do is really important. And so we see increased amount of geotechnical spend taking place within projects. So that's creating demand for those services and buyers are recognizing that and stepping into it. We've talked a lot of times about, where does construction put in place take place? Well, sometimes it's not taking place in the best quality sites, but where construction is taking place is shifting the amount of spend that we need for both environmental as well as geotechnical solutions. And we're seeing a lot of both private equity and strategic buyers really looking at that as a service offering that they want to add or that they think could be really conducive for a long-term growth trajectory within this country.
Alex, speaking of buyers, what role is private equity playing in the current M&A market for E&C companies today?
I think, Scott, sometimes it's helpful maybe to take a step back and not just talk about private equity, but talk about the whole evolution of private capital markets. So, I think in our industry, when we think about private equity, we think about leverage buyouts, we think about the roll-up strategies, right? We have these kind of visual images of what private equity is. And really private equity in the US has evolved into it's an entirely new capital market. It has its own funding, it has its own liquidity, it has its own exit infrastructure. And all of that has really changed the dynamics across all industries. And increasingly, it's changing the dynamic in engineering construction. So, what do I mean by that? I mean, one way to look at this is, there are less public companies in the United States today than there were 20 to 30 years ago. Well, why is that? Well, one of the reasons why that is because, now we have access to growth capital and liquidity from options that aren't available to us, that used to be available to us only by going public. And now we have this entire universe of other capital markets that exist. And so now when firms look at the ability to, hey, I can get liquidity or I can get the growth capital that I need without going through the regulatory scrutiny of going public, it creates an entirely different paradigm within our market. So I think that evolution has had a lot of impact on our market. And you're starting to see these really, really large firms that a generation ago would have gone public that are now remaining private, that are still putting capital to work. But what it's done is that increased access to capital has created larger and larger and larger competitors in the marketplace. Scott, we talk a lot about how, many of our clients, the largest firms in our industry think that this is one of the best markets that they've ever participated in. But the smaller to mid-sized firms don't necessarily feel the same, and they're not participating in the market in the same way. And it goes back to that shifting construction demand and the shifting construction delivery. The demand is shifted into larger, more sophisticated projects. The delivery has shifted into a different way of doing work where more services need to be brought by fewer and fewer participants. Well, then you couple that with a private capital market that's allowed some firms to get really large and scaled relatively quickly. And those are the firms that are going to benefit the most from larger, more complex projects where the owners demand more services out of a single participant. So you put that together and it's created this market where there are really consolidators. And then there are those that have to decide, what are we going to do? Are we going to continue to participate as an independent firm and figure out how we're going to be a niche provider that can stay independent? Or do we need to go partner with somebody who has excess capital and is going to be able to participate in some of these projects? So I think the first is the entire evolution of the private capital markets has just created a different competitive environment for the engineering construction industry holistically. The evolution of private equity has also created something that you'll read a lot about in the Wall Street Journal and other things, which is that there is this wall of private equity exits that exist. I think 30% of all private equity owned assets today are over 7 years old, which certainly exceeds the traditional timeline that private equity tends to like to hold onto their investments. Some of that is because investment strategies have shifted. Again, Private equity today is not what you used to think of, which is that every firm holds for 5 years and they immediately sell. It is a capital market that allows private funds to invest alongside companies to either provide liquidity or give them growth capital. And flexible structures have existed, right? There are firms that are doing deal by deal models. They're having longer hold periods. They have flexible capital options. And so some of the assets that are a little bit older or been aged within portfolios longer are because of new flexible structures that exist. But some of them also has been that this has not been a great environment to exit over the last 2 to 3 years. How is private equity participating in our marketplace? I think you're going to see two things in 26. You're going to see continued increased investment from private equity firms into engineering construction companies. If you want to ask where they're going to participate in the same themes we talked about before. They want access to infrastructure services. They want access to power. They want access to data centers, advanced manufacturing, the areas where construction put in place is growing and where technical skills and labor and talent scarcity exists. Those are the assets that they're going to be investing behind. So we're going to see more of those investments take place, but we're also going to see a lot of exits from those that have already been invested, right? This is the year that we, are starting to think that we're going to start seeing the floodgates open and exits out of private equity, and that's going to create a cascading effect of a lot of activity within our market. The other thing that I just want to mention before we shift off of private capital markets is that in addition to private equity, I also bucket the evolution of ESOPs into this conversation, right? We are increasingly seeing ESOPs not, they're no longer kind of a fallback option. They're a real competitor and a credible alternative to M&A in the marketplace today. And as financing gets more conducive and we come out of an environment where really ESOP financing is lenders are becoming a lot more familiar with the product. They're getting a lot more comfortable with the product. They're able to work alongside your surety to make that work. We're seeing ESOPs really compete alongside private equity and strategic buyers. And I think that evolution creates just a different dynamic within the marketplace as well.
Just building on that, but shifting slightly, I'm curious about strategic buyers and how strategics are participating in the M&A market today.
I think we spend a lot of time talking about private equity because it's new and because it's larger and there's a lot of headlines around it. And what I'll tell you is that strategic buyers recognize that and they are 100% playing catch up right now. So I think about strategic buyers in two ways, right? You've got your public buyers and, look, we participate in the engineering construction industry where 99+% of the firms are private. But those that are public are trading at recent record highs when you think about it on an EBITDA multiple basis. I mean, in the MEP space, as an example, they're trading almost double where they were 5 to 10 years ago. And so when firms are being valued at that level, they have to show growth to show them. I mean, the market is telling them that they expect this to be a growth asset and they expect to see growth out of that. And one of the things we haven't talked about before that we'll talk about, probably a little bit more and probably a lot this year is growth is challenging in this marketplace organically. It is a labor tight market, like we've talked about before. Project complexity, we've talked about before. I mean, it is challenging to grow organically. And so when you're a firm that's being traded at a level that says, hey, I need to grow, I need to justify the valuation that I'm at, the best way to do that is to put that capital and that valuation to work through acquisitions. And so we have seen some really large transactions take place with some of the public participants in our market, both on the engineering and construction side. When you think about the private firms that participate in our marketplace, the same dynamic exists, but for different reasons. So a lot of the largest firms within our industry are coming off some of their best years in recent memories. Like I said before, this has really been a winners and losers market, and the winners have really, really won. And so the firms that are participating in these large mega projects and where the shifting construction demand is taking place, they are sitting on record amount of cash. They have resources to deploy. They want to continue to grow. They recognize that, hey, there have been markets that have really done well here, but I need to diversify. I need to make sure that I'm setting myself up to sustain this level of volume 10, 20 years from now. And they're calling us and saying, hey, how do we put some of these recent profits to work in a way that will set us up long-term for sustained success? And so I think one of the things that we have really seen over the last 5 years is an expansion of firms, even those that are private, who truly are starting to consider M&A as an avenue for growth within their strategy. And I think, I mean, Scott, when you guys used to do strategic development, you do, strategy and you work alongside this, a lot of your customers and a lot of your clients, you know, it was always organic first, organic first, organic first, and we might consider an acquisition. And today, I think that paradigm has really shifted, somewhat out of a necessity and somewhat out of a, hey, we've seen this model work. Can we do it ourselves? And so we're having conversations with a lot of buyers who have not been acquisitive historically, but are really thinking to themselves, hey, I've got this cash, but I also understand that I need to grow, and organic growth is going to be challenging. And what do I do? And they say, well, we got to find capabilities to meet the shifting demand in the marketplace. Owners, like I said before, on the delivery side are asking more of us. And so maybe we need to start thinking about how do we vertically integrate some of these services and give more to the owner. And like I mentioned before, geographic expansion in this market is hard organically. And so for those firms that say, hey, maybe we're not in the right geography, we want to be in Texas or we want to be in Florida, we want to be in some of these growth markets. For many of those firms, they're gonna have to figure out how do they buy their way into that. Long-winded way of saying, we are seeing strategic buyers really step up than we would have seen 4 or 5 years ago. And it's really broadening the base of potential buyers for really quality assets in the marketplace.
Alex, any M&A conversation wouldn't be complete unless we talked about valuations. So, not to disappoint, I'm curious how buyers and sellers are approaching valuation and risk in today's market as compared to previous cycles.
Look, I think in general, valuations today are higher than they would have been a year ago, and they're higher than they would have been 2 years ago, right? So just, if you again, and sometimes it's challenging because we're talking about a very broad market, and you go through that broad market, and you want to go kind of sector by sector by sector by sector to have that conversation. But look, quality assets are more expensive in the market today than they would have been 4 or 5 years ago. And I think it's really kind of two reasons, right? One is that they were underpriced 4 to 5 years ago. Our market kind of dragged behind others and kind of getting to kind of more reasonable prices for valuations for quality assets. But then I also think that there's just been increased buyer demand. And when there's increased buyer demand, you get a more conducive environment for valuations. We talked about ESOPs before. When ESOPs become a credible alternative and when private equity becomes a credible alternative, well, that strategic buyer is not the only person who's going to show up anymore. And like I said, the strategic buyers have really recognized the need to say, hey, if this is what I need, if this is the capability that I need, if this is the asset that I need, if this is the target that is going to fit my strategy, and I have to pay a little bit more than I would have had to pay 5 years ago to get it, I guess I'm going to have to do that. So across the board, multiples have increased for quality engineering construction assets. The one caveat is that there have been some sub niches over the last couple of years where valuations just got overheated, and we're seeing a little bit of a correction in those. So there were a couple of areas where private equity got really, really aggressive chasing assets, and probably got a little bit higher than what was justified in kind of a competitive tension of trying to build assets of scale quickly. We're starting to see some of those come back down a little bit to a more normalized level, but even where they're coming down to is going to be north of where they would have been 5 years ago. So in general, quality assets are more expensive today. There are pockets, obviously, where, we see that premium even more accelerated. Those are those shifting demands that we've talked about before, the shifting delivery methods that we talked about before. People who can really, really meet those trends, you're going to see a premium paid for those. But even those that aren't participating in some of these kind of white hot growth markets, valuations across the board have increased for quality businesses within our industry.
So super helpful. I want to shift gears a little bit and talk about lessons learned. So from your perspective, what lessons from recent M&A deals should leaders carry forward into their 2026 game plan?
A couple of things come to mind. Look, the market remains fragmented. Scott, I think we used to put out a slide that I remember we did that showed ENR 400 as a percent of construction put in place. And the story there is throughout all the acquisitions that have taken place, if you looked at this over a 30-year run, they still held the same market share as they did 30 years ago. And I think that shows you that the market's fragmented, but I think that if we did that again, you would see that change. I think that was something that 10 years ago we would point to and say, hey, while the market consolidates, it continues to remain fragmented. I think we are beginning to see consolidation that is really becoming a force factor within our industry. Again, I'll point back to project complexity. I'll point back to owner demands. I'll point back to shifting delivery methods. All of these are creating an environment where scale and capabilities are really required to compete in this marketplace. And so I think, one of the lessons for those that are independent today is that you kind of have a decision to make, right? I mean, if that is where the world is going and we're seeing this increasing need to be able to meet kind of a shifting demand in the marketplace, I think we're going to have a lot of our clients that are thinking to themselves, do I need to partner with somebody who has that capability? Do I need to partner with someone who has the balance sheet or the design capability that I don't have or the modular offsite capability that I don't have? Do I need to partner with someone to be able to compete into some of these marketplaces? Or do I need to figure out how to build a pretty deep moat myself to remain independent? And that moat has got to be built on niche technical services, right? And so I think that we're going to see a lot of firms that are thinking to themselves, hey, with this, when capital floods into a marketplace, what does it do? It shifts the competitive dynamic. We've been in a period of 5 years now with accelerated M&A activity. That competitive dynamic is shifting. And so I think for some of our independent clients, there's going to be a conversation over the next year or two of what do we need to do to make sure that we can remain competitive in this shifting market. I think for buyers, the lesson to learn is two things, right? And I think that two things can be true here. I told you before that the old paradigms for valuation have changed. To compete in this marketplace, there are less quote unquote deals to be had. And I think that buyers are to be competitive in this M&A market, they need to think strategically and they need to think aggressively, especially when they're trying to acquire a capability that they have to service their strategy. That doesn't mean they need to become lax on diligence. It's actually the opposite. What I think we're going to see, and the lesson that we've learned from buyers is valuations have changed. If you want to be competitive in a process, you need to be aggressive and strategic. But in order to be aggressive and strategic, you also need to make sure that you are diligencing that asset to the same level that you would have, if not more, right? Quality assets are more expensive, which means that the seller needs to truly justify that they're quality assets, meaning buyer needs to get really comfortable. I mean, I think we're going to see increased focus on backlog in the next couple of years. We're going to see a lot more diligence needed to be done on project performance historically. We're going to need to see buyers are going to be really focused on, hey, is this a cultural fit? Have you done the right thing for succession planning? And so the lesson I'd say for buyers is that in a market where you've got to be more aggressive to compete, that means that you also need to really raise your game in terms of the diligence that you're doing to make sure that these assets justify the valuation that's going to be required to compete in the marketplace.
You said something earlier that reminded me of something one of our former colleagues used to say, which was in a fight between you and the world, bet on the world. If this is where the world is going, if you kind of think about a couple things you shared so far, Alec, it's kind of the tale of two markets, not to butcher a famous author, but there's the haves and the have-nots, given the trends and where things are headed and your example of the percentage of put in place that was comprised of E&R 400 firms coincides with the fact that the percentage of construction put in place that's now mega projects north of $1 billion, 10 years ago versus today, very, very different story. So I think all that hangs together to kind of reinforce the points you're making around kind of where we see this moving.
The other thing that I'd want to point to is, when you talk about trends in the M&A and the NC industry, we're going to spend a lot of time talking about power. We're going to spend a lot of time talking about data centers. I mentioned before, hey, there are some markets that are slower growth, and that's really where the maintenance spend, and that's really where the recurring revenue and the ability to provide kind of retrofit maintenance O&M services is really leaning together. There's a market in between that we're seeing increased activity in, and that market is more that institutional market. So you think about, in a spectrum of end markets, we have our high growth markets, the manufacturing, the data center, the life sciences. Those are our really high growth markets today. They're technically complex projects. There's a handful of participants that compete in it. We got to acquire the capabilities to be able to service the owner's demands in those markets. We have our slower growth markets where capital is flooding to make sure that we can maintain and service those assets. And in between those is the institutional market. And what we're seeing there is that buyers are really leaning into those institutional markets. Think about healthcare or education. And while those markets may not be as high growth in 2026, they're stable. And if your investment thesis is, hey, it's a scarce labor market, access to talented labor to service demand moving forward is going to be critical. A stable institutional market is not the worst place to be also. And so we're seeing both private equity firms and strategic buyers who are saying, while we love data centers and while we love power, And while we love advanced manufacturing, we sure would love to see that portfolio mixed a little bit with something that's a little bit more stable, that may not be the highest growth market that we see today, but still has a high barrier to entry. You have a technical labor force or a technical engineering force or a technical talent force that can service that market. And it's an area where institutional markets are seeing a lot of demand as well. And I just want to make sure we reference that we don't spend all of our time just talking about the big shiny objects. Those core stable markets are still areas where we're seeing a lot of investment demand.
Well, Alex, that's probably a great place to leave the conversation. Again, I just want to thank you for making the time to do this. It's always great to hear your perspective. This is your life's work and you're in it all day, every day. And so appreciate you taking the time to do this.
Thanks, Scott. I appreciate it. Happy New Year's to you and Happy New Year's to everybody listening to this.
To our listeners, we hope today's conversation helped you think more intentionally about how market conditions, capital dynamics, and strategic priorities intersect when it comes to M&A decision making. Up next, in our next episode, we'll continue the theme of looking forward with a conversation with Jay Bowman on FMI's 2026 U.S. construction market overview. Jay will help frame what we're seeing across the built environment and how leaders can translate those signals into sharper strategic choices in the year ahead. As always, thank you for joining us on FMI's Built-In Podcast. If you found today's episode valuable, please be sure to like or subscribe so you don't miss an upcoming episode. And we appreciate your listening.